Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the GDP numbers and what they mean for mortgage rates and housing. I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah. With the news that came out this morning and, possible tariffs coming in tomorrow, we thought we had to just jump in here and try to explain all the madness in economic data.
Absolutely. Okay, let's start first with, today's headlines. This is Monday about GDP, because I think that was pretty shocking to some people.
Negative 2.8% GDP. Now, the Atlanta Fed GDP tracker, it gets more prolific as the quarter goes in because it just basically takes in real-time input data and then incorporates into what the estimate is. So before this revision negative, we had about a negative 1.8% GDP. A lot of that was tied into people buying stuff before the tariffs came into place. And then that really messed up the export-import portion of GDP. So that was the big reason it was negative. However, now consumption data has been softening up. We saw that in the personal consumption data last week. This has nothing to do with the Doge cuts because this is January data. One of the things we have to be mindful of is that it was cold in January, right?
It was.
It was, trust me, doing the nerd tour, I was freezing half to death. And whenever you have cold weathers, it can impact the data lines. We've had this actually happen in previous years as well. So early on, a huge portion of this can be related to the export data, import data, and then there's some weather related. So it can, in a sense, get a little bit better as the quarter goes on and they put more stuff in it. But today, manufacturing data, new orders, negative, like a big miss. Prices paid was up too. So again, this is the series of economic data lines that are missing estimates, and the 10-year yield goes lower. One of the Fed presidents even talked today that, a little bit concerning, housing being weaker, consumption pulling back, keeping an eye on this. But it is somewhat confusing because really, if we had an authentic negative 2.8%, the 10-year yield is breaking below the Gandalf line. That's below 3.37. Mortgage rates are in the low fives, in the high fours, something to that nature. But it isn't that. The headline could be a little bit confusing. So this is something to think about going out in the future because, again, now we have government withdrawing money from the economy as policy. There are states that have budgets that are tied to the federal dollars. If that's less, then the economic data doesn't get better in that environment. It gets worse, right? That's when you withdraw. So if your goal is to bring down inflation, bring the economy lower, you attack the labor supply and aggregate demand. How do we know this? The White House Economic Council talked about this. So it's a lot to take in for the first 2 months. We're obviously in March now, but by the time this podcast comes out, we'll see if the tariffs are put into place or are they delayed back. But one of the interesting aspects of the manufacturing report is that you're starting to see businesses going, hey, I don't know the rules. I don't know if I want to invest. This is very similar to what happened in 2018 and 19. That's why we talked about that on November 7th, that there's limits to what you can or can't do with a trade war tap dance. And if the manufacturing surveys are saying, we're just not sure if we want to invest, this is what happened back then. And back then, the rates were lower. The growth rate of inflation was lower. The corporate tax cuts were put into place before the trade war tap dance just to give everyone a wiggle room. And even with all that, business investment went to zero back then. So it'll be more interesting as the year goes on. But wow, that is a huge amount of data to take in a very short amount of time and try to explain it to people.
It really is. Okay, so tell me what you said, that the 10-year yield didn't have maybe the giant reaction that you would have thought because maybe the market's also understanding that, it was January, it was cold. We had these circumstances. So where are we right now, and are we where you thought we would be?
As of this second, it's 4.18%. So it's obviously lower than what we had at the high of 2025 around January 14th. It was about 4.79. But if we authentically had like a negative GDP because consumption was really falling apart and stuff like that, the 10-year yield would be much lower than what it is today. And you know, I get questions about that, like why is it the 10-year yield lower? So trying to explain the Atlanta Fed tracker, a GDP tracker, is a little bit confusing for people, because if you have a one or two big misses in GDP components early on, it could really tilt the data up or down. And that's what it is. And it's jobs week. And of course, with jobs week, jobless claims have been picking up lately. We're firing people. So there's all these things that are in place. And we talked about it, over 2 months ago. You know, if you're trying to bring the 10-year yield down or inflation down, one way to do it is slow the economy. Economic growth goes down, and labor supply grows. And again, we're not the ones that made this policy, but Treasury Secretary Bissett on Friday said in about 2 weeks the housing market is going to be unfrozen.
Yeah,
So
okay, so let's talk about that, because I immediately called you and was like, "Okay, what does that mean? What should we expect because of that?"
not the words I would have chose, because if you ever put a time frame into something, your first reaction is like, what does he know that we don't know?
Right.
And today, the negative 2.8% GDP, people are like, what? I mean, people are just assuming that he knows the economic data is getting worse, and he's trying to front load it and say rates are going to go lower. But yeah, it's unfrozen housing market. We had this talk today with one of the more well-known Wall Street types, and he said that lower mortgage rates won't help housing. And he looks at the builders stocks out there. And my argument is that we've seen the data get better, but that's when mortgage rates head towards 6%, not here. And last year, what we like to do as part of the tracker articles to give people updates on what's happening with the purchase application data with rate levels. And last year, 6.75 to 7.5%, 14 negative weekly prints, 2 flat, 2 positive. Not very effective in that nature. Here, if the purchase application data is getting is a little bit better than what we had last year, but does this mean that we have less cash buyers this year than last year? And that's why the data line is still showing year over year weakness. In any case, it's gotten some of the Fed president's attention. And we always say that economic cycles, you look at housing data, residential construction workers, when they start to lose their jobs, that's typically a precursor to a recession. The Fed tends to ignore this data line and start talking about, well, the economy is strong, we don't need to cut rates. And by the time they do, it's a little bit too late. So a lot going on, Sarah, so far in 2025. But I always hearken people on, let's go all the way back to November 7th and talk about what can possibly happen with a trade war tap dance, what can't happen. And higher rates at this point of the cycle is a little bit more problematic for the builders than it was before, because their total units construction is growing. And business model, right? Think of them as a business. Don't think of them as somebody trying to create massive amount of supply. They don't flood a market because it ruins their profit margins. So they're withdrawing in permits, and they're just trying to get the stuff sold that they have that are coming either to the market completed, or making sure that those contract buyers are good to go to sign the loan and get on to the property. Remember, they sell homes as a commodity. They don't have the relationship that the existing home seller or buyer does.
So when you look at, of course, for you, it's always jobs over inflation. That's what the data we're going to get later this week. But do you feel like what's happened over the last week with all the data is strengthening, the case that the Fed actually needs to cut rates?
So the market has pretty much 2 rate cuts for 2025. Last year, the Fed was talking about we need more confidence, and the 10-year yield was rising early on in the year. And what it did is it brought mortgage rates to 7.5% last year, and we had our first negative residential construction. And then rates finally went lower. So there's an ebbs and flows, and since 2022, we always get one of these. Every year there's always a growth scare. Economic data misses estimate. It tends to happen when bond yields are up, so there's weakness in the economic data. But you're running the risk now, right? It's a little bit different. You had a cushion the last few years with the labor data and everything. You don't really have a cushion anymore, right? The labor market's getting softer, but it's not breaking. But now jobless claims are rising. We're firing people, households. We're withdrawing money. You put all these variables together. 2025 is different than the previous years. And we have not issued like universal tariffs yet because remember, the trade war tap dance, business investment, right? They're just not sure what's going to happen. So we're working with a lot of stuff, and it's all come getting into the data pool in a very short amount of time. And it looks very bearish, right? It looks, you don't have negative 2.8% GDP unless something bad is happening. So we're trying to explain it all, but again, jobs a week, jobs Friday, jobless claims Thursday, and the labor report on Friday. Following week, we're going to get the job openings data. You put them all together, it's not shocking that the 10-year yield is here. But if we really had a hardcore negative GDP and it was going to stick here for a while, the 10-year yield, we're talking about 3.37. We're talking about much lower bond yields. The market quite doesn't believe it, so we're not there yet, but you can see why mortgage rates have been falling.
So if we get those negative job reports, you think the 10-year yield will be ahead of the
10-year
Fed,
yield
right?
goes
They'll
lower.
react
Absolutely every
immediately.
time.
Okay.
The bond market 3 different times has tried to get ahead of the Federal Reserve. All 3 times it has been rebuffed when the economic data started giving it. Last year was a really good example. We had a 2% move lower in mortgage rates from the peak of 2023 at 8% all the way down to 6%. We had the Fed cut rates 0.5% on that day, but then all the economic data started to get better, right? So when yields go lower, things tend to get a little bit better, and when they go up higher, things tend to get worse. So it's the flow of the economic surprise indexes either be negative or positive, but now it's a little bit different now because the job growth data is slowing down, and we are intentionally firing people, and we're withdrawing money. So you don't have much of a wiggle room. This is why I believe the White House, the economic team, Treasury Secretary, they want lower mortgage rates, right? Because there is one sector of the economy that the existing home sales market has been in recession since June 16th, 2022, 5:31 p.m. But the builders now, right? This is why we highlighted it. 2025, the wild card was the builders, and now you get to see they're very stressed, and they don't want tariffs on lumber, right, out there. So I kind of joke that Trump is talking about national security concerns of the Canadian lumber coming into the marketplace, and I just thought of the Ents, the last march of the Ents. Here comes the trees attacking America. Get the national security out. We need tariffs, right? So a lot's going on, right? And it's when a lot's going on, you could see why these surveys are talking. We're not sure what we're going to be doing next until we get some clarity on the rules.
Okay, so let's dive into tariffs a little bit. Like you said, we're recording this on Monday. Tomorrow, March 4th, is one of the deadlines that has been set for some of the tariffs, but it's very unclear what that looks like. In the interim, this weekend, Trump signed an executive order on Saturday that called for the immediate expansion of U.S. timber production to increase the supply of American lumber. And to do that, he tapped various resources, but that's going to take a while. That's not something you can just turn on. For instance, he asked various agency heads to come up with a plan for what percentage of federal lands should be logged, or how much board feet of timber of lumber should we get from federal lands. So it feels like we're still kind of a long way off from any of that having any sort of impact on lumber. What are your thoughts?
More sawmills. We need more operators. If you want to do that, I would tell you this. I have few very, very smart lumber guys, and they are not happy because it's going to take time to get this going. It's going to a few years. So from here to there, lumber prices are going to go up. Margin compression, right? Where we talk about the builders' concern is supply and margin. So in a sense, you can spend the next few years preparing, but you're going to need more people, right? It's not lumber or wood itself. We need the whole operation has to expand higher. You need more workers, more sawmills, and then you could get something like that going. But at this stage, you saw the builders' confidence completely collapse, and they were like, I think they were the first industry that wrote a letter not to do the tariffs at this point. So again, what we've always said about the trade war tap dance is that there's going to be a lot of back and forth. When you go early and you start talking about tariffs and you don't do them, you're going to have to eventually do something, or else everyone's saying you're bluffing the whole time. So it is interesting to me to see what happens, but you could also see the builders are not happy about this. We're not prepared for anything like that to
So
happen, but it'll take time.
it's a good point that you point out. I mean, I think they were the very first people, and what they called for was a carve out in the tariffs for anything that was building materials, right? Any building supplies, and they haven't gotten that. As far as I know, that has not been carved out. So I think that that's where there's been it's timber of other things have been levied or said they were going to be levied for steel, for aluminum. So all of those things affect them. In this particular executive order, one of the things that they might be happy about is that he really cleared the way. He's like, we need to reduce processes and cost of administrative approvals for timber production. And he was like, if that means we have to basically, change the regulations, like he called for widespread, just sort of cutting the regulations that have kept this part of the production down. But to your point, it's not just that. It's not just like, oh, can we go in and log lumber or trees? It's like, what do you do with them after that?
It's when the builders wrote that letter to the White House, basically asking for kind of the assistance on that. You have to remember that if you're going to build stuff at home, you better have the proper people, institutions, machines, and ready to go, because you are doing a supply shock. So what do we talk about? Inflation. Inflation can be driven by supply shocks. If you're not going to bring in lumber from Canada, you're going to have to produce it here. You're not in the position to do it. That's a supply shock. That's inflationary, right? So we're seeing that in lumber prices, future lumber prices, right? So if all you're going to talk about is tariffs and you don't do them, then the market is going to call your bluff. And the president's personality is he doesn't like to be called out, and then you might do something that you don't really want to do, and it might not be very long. You could have tariffs for like 2 to 3 weeks before something, but you can understand why the builders are just not quite vibing this type of mechanism now, because supply is increasing, rates were elevated. But as you can see why the White House and the economic team wants rates to go down, right? For our economy and in a consumption-based economy, it's better in that. So again, you're throwing a lot of variables in here, and this is one of the things with the manufacturing survey is that they're quite not sure what to do with investment because they don't know what the rules are. So clarity will be fine. Again, if you really believed in the concept of tariffs, you would literally do them day one and you would never take them off, ever. Right? There's no negotiation, nothing. You would just simply allow the tariffs to work out. We have other countries retaliating. That's why I'm not a universal tariff person. Nobody wins in a trade war, right? Back and forth. But if you want to use it as a negotiation tactic, then that's fine. That's what he's done in the past. but you can understand why the builders are a little bit more mindful of the future now.
Boy, I really can. Okay, so we have so many things happening this week. We will have you on again very soon, maybe even as soon as tomorrow. We're just looking at what's coming in and asking you to make sense of it. So thank you so much, Logan.
Yeah, it's jobs week, and remember, Jobs Friday. The jobless claims is always key now more than ever because we're purposely laying people off, and just remember, job growth slowing down, and if the labor force is constant, then the unemployment rate can go up. If the labor force is growing and job growth slows, the unemployment rate can go up. The unemployment rate can stay at bay or go lower if the labor force starts to shrink. But that's not what we're trying to do here. We're trying to expand the labor force. So the government jobs, again, a lot of it is state and local that were being hired last year. So that's why we focused on that 4.3% unemployment rate. Like that was the Fed's target. I personally believe they kept it low for a reason, just in case if something happens, then they're telling the marketplace, hey, listen, this is what we're gonna have to do a little bit more. And when the Fed president was talking today, he had mentioned that if we're in a good place if we can do more if the labor market starts to get weaker, right? So paper, rock, scissors. Right, the growth rate of inflation has fallen a lot, right? We got two handles, 3, 6, 12-month PCE. But to get that next stage, you really need to see the economy get weaker. And again, this is fourth time now since 2022, bond yields have fallen. There's an economic growth scare, and we're trying to make sense of the data. I would say this period of time is a little bit different than the last few years.
Okay, so I was about to sign off without asking you about another big thing that happened on Sunday, which was they announced that they're going to potentially publish the economic data, right, the jobs data, and strip out some of the government jobs. So explain that, because that's something we talked about a couple weeks ago.
So I think that's going to be like the GDP component. So, pardon my coughing. A few weeks ago, we talked about that. We shouldn't be surprised if the unemployment rate goes up, and they're going to say, okay, well, this is the unemployment rate for just the private sector, but this is the unemployment rate now, and this is just because the government workers, and we're not going to count the government. So the Commerce Secretary brought this up, that they might just take the government spending or government data out of the equation out there. And we talked about that a few weeks ago, that expect something like that to be announced, and they brought it up over the weekend. So, Sarah, it is what it is. This is just, things are a little bit unconventional with President Trump. So we try to model this out or try to figure it out what it's going to be. But if people have listened to our podcast from November 7th, 2024, all the way up to here, not a surprise to me about any of this, right? Because we had a test run early on. So again, if you're playing the person, if you have a period of time that you could work off of, we did. And I mean, oddly enough, it looks kind of right with everything that we've mentioned. So, but always remember, if the labor data starts to break and the unemployment rate, guys, just for housing, for everybody listening, the housing market tends to outperform, right, in this environment. And we always harken back to the early 1980s because affordability was worse. There was a recession. People said we're a renter nation. Nobody's going to buy homes ever again. All of a sudden, rates dropped 2.5%, vertical move in existing home sales. So this is not a shock that they're all talking about wanting the 10-year yield and mortgage rates go down, because Reagan had that recession early in the 1980s, and what helped back then was mortgage rates going lower. So playbooks are very similar in that sense. So this is, you take their words seriously, they would not be talking about 10-year yield needs to go down, unfreeze housing, mortgage rates go lower, end property taxes. This is all surrounding one thing, the United States housing market.
All right, Logan, thank you so much. Appreciate you. We'll talk again soon.
Pleasure, Sarah.